Chase pays you nothing. Not close to nothing, nothing. The standard Chase savings account pays 0.01%, which is 1/100th of 1%. Bank of America pays the same. Wells Fargo's Way to Save account pays the same. Three of the most recognizable names in American banking, all landing on the exact same number. And here's the first thing that surprised me while I was putting this together. I went to Wells Fargo's own savings rate page to read the number straight from the source. It wouldn't show me one. The page told me rates were unavailable and gave me a phone number to call. So that figure comes from a rate tracker instead, Forbes, which has Way to Save at that same 100th of a percent. Now, Chase does have a step up from that standard account. It's called Premier Savings, and it pays 0.02%, which is double. Double of nothing is still nothing. On $10,000, a full year of Premier Savings earns you $2 instead of $1. Sit with that for a second. A bank built a premium product, put the word Premier in the name, and filled it with $2. Percentages are slippery, though. 0.01 sounds small, but small compared to what? So let's put a real balance behind it. Say you've got $10,000 in a Chase savings account, the emergency fund, the thing you spent years building. At 0.01%, that money earns you $1 a year. $1. You could not buy a coffee with a full year of interest on $10,000. Now here's that same $10,000 at Marcus, which is Goldman Sachs' online savings account. Marcus pays 3.4% as I'm recording this in July of 2026. That's $340 a year. $1 or $340. Both FDIC insured, both perfectly ordinary savings accounts. And the only thing you changed was which bank's website you typed the money into. And Marcus isn't some outlier I hunted down to make the gap look dramatic. That is the going rate. Ally Bank pays 3% with no minimum deposit and no monthly fee. Marcus, the Goldman Sachs account we just looked at, pays 3.4. SoFi's checking and savings account advertises up to 3.8. And CIT, which these days is a brand of First Citizens Bank, not a bank of its own, pays 4.1 on its Platinum savings account. These are ordinary deposit accounts, and you have absolutely seen some of them advertised during a football game. But the rate you see in a headline is rarely the rate you get. So here are the catches, because I'd rather you hear them from me than find them in the fine print after you've moved your money. SoFi's 3.8 is promotional. It's 3.1 normally, plus a boost that lasts up to 6 months, and only for new customers with an eligible direct deposit. CIT's 4.1 requires you to keep $5,000 in the account. Wells Fargo will tell you fairly, that their Platinum savings tier pays a great deal more than 100th of a percent if you keep a large enough balance parked in it, and depending on the offer, link a checking account too. That's true. It's also not the account most people are actually in. The rates are real. The conditions are also real. Here's the number that reframed the whole thing for me. It doesn't come from any bank's marketing page. It comes from the federal government. The FDIC publishes a national average of the savings rates that insured banks are actually offering. And as of June 15th, 2026, that average sits at 0.38%, which is dismal. It's a fraction of what Ally or Marcus will pay you for the identical deposit. But hold it up next to your bank, because your bank pays 0.01. Chase isn't merely below average here. Chase is 38 times below a national average that is already bad. So line them all up in dollars on the same $10,000 for 1 year. Chase pays you 1. The national average pays 38. Ally pays 300. Marcus, 340. CIT, 410. Every one of those is the same money, sitting in the same country, insured by the same federal agency. The only thing separating $1 from 410 is which website it's sitting on. The Federal Reserve didn't hand that gap down. You didn't get unlucky in a market. It exists because the money is sitting still, and nobody at Chase has any reason on earth to email you about it. Which brings up the thing that stops most people from ever moving a dollar. So is an online bank safe? It's the first question everyone asks, and it deserves a straight answer. Here's the FDIC's own wording exactly. Quote, FDIC deposit insurance covers $250,000 per depositor per FDIC insured bank for for each account ownership category. Read what that doesn't say. No separate category for online banks. No reduced coverage for having no lobby. The insurance attaches to the bank being FDIC insured. That's the only test. Marcus is Goldman Sachs Bank USA, that Goldman Sachs, insured since 2008. Ally since 2004. Same Federal Register as Chase, same $250,000 of coverage behind it. One qualifier: confirm the bank is FDIC insured before you send it money. Don't take my word for it. It's on the FDIC's own site, 30 seconds. A good rate is not the same thing as insured. So why does Chase pay 1/100% while Ally pays 300 times that? The uncomfortable answer is the simplest one. They don't have to pay more. An online bank has to buy your attention with a rate because a rate is most of what it's got. No branch on your corner, no name your parents banked with. Chase already has your paycheck, your app, your debit card, and 20 years of inertia, so the rate becomes whatever they can get away with. And what they can get away with turns out to be $1. And there's no villain here doing anything illegal. The rate isn't a secret. It's disclosed somewhere to someone on request. It's just that nothing about it is built to be read. Nobody is going to interrupt your month to mention that the money is sitting there earning $1. The rate is published, not announced, and the whole thing runs on the safe assumption that you'll never go looking, so the money stays put. So, the actual thing to do. It genuinely takes about 10 minutes. You open the account online. These are online savings accounts. That's the entire product, and there's no minimum deposit to open. Then you move your savings into it, and your checking account stays exactly where it is. Your direct deposit doesn't move. Your bills don't move. Your card keeps working. Nothing about your day-to-day changes at all. That's the entire change. Your savings just lives at a different address. Marcus, say, paying 3.4% as I record this in July of 2026. $340 a year instead of $1. 10 minutes. That's the distance between $1 and 340. One last thing, the thing I'd want somebody to tell me. Every year that $10,000 sat in a 0.01% account, it earned you $1 and cost you $339. Nobody charged you that. Nobody took it. It's just what didn't happen, which is exactly why it never shows up on a statement, never triggers an alert, and never makes anybody angry enough to move. So go look up your own rate. Right now, before this leaves your head, open your banking app and find the APY on your savings account. If it starts with a 0.0, you now know exactly what that number costs you every year, and you know it takes 10 minutes to stop. And that's the honest answer. No hype, no noise. If it helped, hit subscribe, and the next one comes right to you. Skip the noise, build real wealth. See you in the next one.